Hello, Mark Sturdy here with another run through our work this week with the highlights of our analysis. And if we look at the summary page, you will see that we remain bears of the dollar against the euro, bears of the yen against the dollar. We have pulled back from being bullish of the Euro Stoxx 50, and as we already had of the S&P 500, there are questions to be answered there. But we remain, for the moment, bullish of the FTSE, bullish of the Nikkei. We are now bullish of yields in the US Treasury note, bearish of prices, of course, and we're bulls of gold. Let's just go through. I think the situation in dollar-euro is well established and unremarkable. We're going sideways. I concede we are going sideways, but I note the strength of the euro bouncing from these two prior highs once, twice, three times. And for the moment, we are in favor of a breakout on the upside, continuing this preceding trend, and we think it goes up that way. Admittedly, there has been a strengthening of the dollar, but it's within this well-established trading range, and so we don't give it that much credence for the moment. Dollar yen, well, we are excited by breaking through this prior high in 1998. With a breakup, the completion of this triangle, we think it sends it on a lot higher. Bluntly, that's our position. The triangle was completed by this pattern inside it, which was a head and shoulders reversal. It goes a lot higher, we think. So we're bears of the yen against the dollar and bears of the dollar against the euro. Coming to stocks, why are we losing faith with the S&P 500? Admittedly, the long-term trend is intact, but we're more and more impressed by the fact the market can't get above this prior high, 70.14. Last week, it had the catalyst, if you like, of this triangle, which did complete once, twice, 3 days in a row, or rather 2 days in a row, and then the market tried to go higher above 70.14 and failed. And we consider that a bit of a disappointment for the bulls, and therefore we're withdrawing from, not exactly bearish, but we're withdrawing from our bullish stance there. So to the Euro Stoxx 50, we think it looks a bit extended above 55.24. The acceleration of the last few days makes it vulnerable to setbacks in a way that the FTSE 100 isn't, driven by this continuation head and shoulders. Admittedly, it's achieved the minimum move, so it is vulnerable a bit, but the price actions are very strong, and we think it remains good. The Nikkei 225, it has, rather like the FTSE, achieved the minimum move of this triangle, which drove it up through the 39,600 prior high, this triangle here. However, we still like the look of it. The US Treasury notes, the new position we've taken. Admittedly, the long-term trading range is obviously well intact. But within that trading range, we think we've found a head and shoulders reversal driving yields higher. This is the yield trading range. And in the price chart, this is a daily price chart. That's the weekly yield chart. This is the daily price chart. We think the markets break down through 1198, and the breakdown through potentially a neckline of complex double-headed head and shoulders at the end of last week is bearish for prices, bullish for yields. German bonds less exciting, gilt 2 less exciting, though we favour lowering yields. We're impressed by this long-standing situation and the completion of this head and shoulders top, but short-term it lacks clarity, so we're standing back from that. Oil, trading range, nothing much going on here. Gold, well, we know the story. It's a rally. It's gone far beyond its original targets, sustained by continuation triangles. There's still more to go in this continuation triangle, and so for the moment we remain bullish. Thanks very much.